Thank you, Mr. Chairman. I want to come back to basically what I talked about in my opening statement, which is the fact that while we debate the consequences and the circumstances surrounding the debt ceiling battle we're having in the Senate and the House right now, the real issue that we need to be focused on, and I agree with all of the comments about the seriousness of the consequences that would occur if we do not pay our debts. I understand that. But it seems to me that the real threat of default that the United States is facing is the debt crisis that we are facing. I look back, we all know that one credit rating agency has already downgraded the United States, the good faith and credit of the United States. They didn't downgrade it over a debt ceiling. They downgraded it because they lost confidence that we are willing to deal with our debt. And that is the issue that I believe we need to focus on. CBO has recently stated that if we continue our current path, at some point, investors would begin to doubt the government's willingness or ability to pay U.S. debt obligations. I think at some point, and I think some point soon, another credit rating agency is going to become convinced that we will not deal with our debt crisis. And so the question I have to the panel is the threat of default that each of you have talked about, default on our U.S. Treasury obligations, is that threat greater because of the fight we're having in Washington right now over whether the debt ceiling will be extended? Or is it not far greater over the fact that we cannot get into negotiations to resolve our entitlement spending and to reform our tax code? Mr. Stevens, I know you mentioned this in your comments, so let me start with you on this end.
Well, Senator, as I said in my oral statement, I think creditworthiness depends upon two things. It depends upon paying your bills on time, and it also depends upon not racking up so much debt that you can't support it. And so it's a combination of the two things. I don't think you can have one without the other if you really want to maintain a good credit rating.
Mr. Thomas?
Yeah, I would agree. I think you have to attack both, but you have to do it in a deliberate manner that does not upset the international marketplace. So I think we have to deal with the debt ceiling first, and then go on to the looming question, the elephant in the middle of the room, and that is the entire debt.
Mr. Benson?
Senator, the two are certainly linked, but it seems to me that just as you would if you were going through, say, a corporate restructuring, if you were going to go through a fiscal restructuring of the United States to repair fiscal imbalances over the long run, you were still going to need to access the credit markets and the capital markets to do so. And so you wouldn't want to do anything that impairs your ability to access the credit markets, to get on a glide path wherever the policymakers want to take fiscal policy. So while I do think they're linked, no question, and they both need to be resolved, you do have one that is in front of the other. And so I think you want to be careful not to make the longer-term job any more difficult by not addressing the short-term issue.
Mr. Keating?
Well, I agree with Ken Benston. There are two issues, but they are interlinked. In the case of, let's say for me as a community banker, if you came to me and you said, I'd like to borrow some money, but I'm not sure I can pay it back, I assure you that the interest rate would be considerably higher if I made the loan at all. If you said, I won't pay it back, or I haven't paid back my other loans, I wouldn't make the loan at all. So that is a reality that faces families, and that is a reality that faces the United States. But a big part of our debt, the reason we can't pay our bills or the reason we won't pay our bills, is entitlements. So they are linked together, and as I said, mercifully, our families are living longer, but that is a huge actuarial challenge that we have not prepared for.
Thank you. And I'm not going to ask another question, but I will conclude with a comment, and that is, I understand the linkage. There's another aspect of the linkage here. We just had a hearing about an hour ago with Secretary Jack Lew, Secretary of the Treasury. And in my questioning of him, I asked him whether or not the real threat we faced wasn't the long-term debt crisis, and that was a greater threat to our creditworthiness. And in his answer to me, he said, you know, we've been making some progress on our long-term debt crisis over the last couple of years. He admitted that we haven't touched entitlements, haven't touched tax reform. But he said, you know, we have, in the last couple of years, started to make some progress. I pointed out to him, and I will point out to you, that progress came in 2011 when we were fighting over a debt ceiling increase. And we adopted the Budget Control Act, which put into effect our ability to deal at least with discretionary spending. And although we can argue over whether that was done well or whether it could have been done better, the fact is that that debt ceiling increase was accompanied by some fiscal reforms. And that's what we are trying to achieve here today.